Today, we're presenting SMCI Super Microcomputer, which is currently trading at $30.54. We have a 12-month projection price of $47, which represents a 54% upside. Our consensus is buy to hold, and I'm Johnson Chen. I'm from Rochester Adams High School.
I'm Jacob Liu. I'm from Troy High School.
This is our agenda for today. We're going to be going over target and industry overview. So Supermicro is the world's fastest growing server OEM, full stop. So it's a flywheel. It can increase its production rate in-house extremely quickly. And its current strength over its competitors is it has a 6 to 12 week time to market. So it captures customers extremely fast compared to its competitors of 6 to 12 months to market. And the numbers are truly staggering. Quarter 2 fiscal year of 2026 hit a revenue of $12.7 billion, and the guidance has been increased to $40 billion plus in this year. And they currently have a $13 billion backlog in Blackwell Ultra, which we think could be a very good thing for them next year. And one thing that we want to point out is one customer currently represents 63% of Quarter 2 revenue, which highlights a significant risk.
So SMCA operates within the AI server market, which is massive and currently accelerating. The global TAM is projected to grow from roughly 125 billion in 2024 to over 400 billion by 2028, representing a 34% compound annual growth rate. And liquid cooling is expected to grow from 5 billion to 25 billion at a 50% CAGR. The key catalyst for all this growth is in generative AI scaling, enterprise AI deployment ramping up, and sovereign AI initiatives worldwide. When we look at SMCI's competitive positioning, the standout factor lies in speed. While Dell and HPE take 6 to 12 months to bring new GPU-based systems to market, SMCI does it in 6 to 12 weeks. SMCI also leads the market in liquid cooling with roughly 25 to 30% market share, but the trade-off is in the margins, where at 6 to 11%, the company runs well below Dell's 20% and HPE's 30%.
We're going to be going over our thesis points for investing in SMCI now. So our first point is SMCI is the purest pick and shovel play on AI infrastructure. And we really want to emphasize that in AI, the people that are selling to AI companies right now are the people that are guaranteed money. And we're going to put this into perspective. Fiscal year 2026 revenue is guided to be $40 billion plus, which is a massive increase from 22 billion back in 2025. And no other OEM server is growing anywhere near this. SMCI currently holds around 15 to 20% market share in GPU servers and 25 to 30% share in direct liquid cooling. We really want to emphasize that these two things will continue to grow for both revenue and gross margins. And like Jacob said previously, the AI server total addressable market is growing at 34% CAGR to 400 billion by 2028. So our second thesis is where some investors may get off of the bus. And this is because gross margin has compressed drastically from 18% at the peak of 2023, and it's moved all the way down to 6.3% for the current quarter. And here's our contrarian view. The market is pricing in permanent margin impairment, while we think this is just a trough. The structural bull case is that the direct liquid cooling market will increase SMCI's gross margins. And this is because it's currently around 20% revenue today, but we think next year it could be even 40% plus. And this is a very highly profitable marketplace for SMCI. And the realistic recovery band is around 8 to 10% over the next 12 to 18 months.
So our third thesis is a bear thesis centered on governance. EY resigned as auditor in October 2024, citing integrity concerns, which is shocking for a company of this size. BDO, the replacement auditor, has issued an adverse opinion on internal controls, and both the Department of Justice and SEC investigations remain open. There has also been a prior 17.5 million SEC settlement from 2020 that creates a pattern risk with regulators. Yet on the positive side, a special committee found no evidence of actual misconduct, financial statements have been validated without restatements, and the board has been reconstituted with a majority of independent directors. The key catalyst to watch is this. If the DOJ closes without charges and BDO issues a clean internal controls opinion, we could see a 30% plus re-rating in the stock. Next, we'll move into valuations. So for our financial projections, we have fiscal year 2024 through fiscal year 2029. And the key thing to look at is this. Fiscal year 2026 is expecting 40 billion in revenue, and fiscal year 2029 is expecting 66 billion. SMCI is growing year over year at a higher rate than any other company in the industry, but margins are struggling. 8% in fiscal year 2026 with projected 11% in fiscal year 2029. For our competitive analysis, we use relative valuation comparing the company to its peers, such as Dell, HPE, Lenovo, and others. Through this, we receive an industry median EV/EBITDA multiple of 20.92x, and applying that to SMCI's TTM EBITDA value gives us an implied share price of $43 per share.
So we're going to be going over our DCF sensitivity evaluation. So currently the share price is $30.54. We calculated a WACC of 13.96% and a terminal growth rate of 4%. We think these numbers are both very conservative given the AI tailwinds and market pricing. And we've projected a 10 to 20% growth rate for around 2028 to 2032. And our blended price is $47 again, which implies a 54% upside potential.
Next, we'll move into ESG considerations. So SMCI's ESG profile is actually quite mixed, with the environmental side being very positive. Their DLC technology delivers roughly 40% power savings versus air-cooled alternatives, making it the greener solution as data center power demands explode. Social is neutral at 6,000 plus employees, but governance is the concern, as we have previously discussed in our third thesis. Yet, improvements are being made, with 67% of the board being refreshed post-2024.
And we're going to be going over AI opportunity and risk analysis. This is the intellectual core of both our bull and bear case. SMCI is the most direct public equity expression of AI infrastructure spend. And we believe hyperscaler capex is running around 465 billion annually and is headed towards 700 billion by 2028. The one structural risk that we want to emphasize is some companies like Google, Amazon, and Microsoft are working on their custom silicone places in-house, which could decrease SMCI's total addressable market contracts. We think the current risks are outweighed by the opportunities because a lot of these in-house things have been going on for years and they haven't actually come to fruition.
So for our Porter's five forces, we rate customer power 4 out of 5 because one customer represents 63% of its revenue. Competitive rivalry is 3 out of 5 because Dell and HPE have invested aggressively into liquid cooling. Supplier power is 4 out of 5 because NVIDIA covers 80% of SMCI's products. Substitutes is 2 out of 5 and favorable because there's no real substitutes for on-premise AI training at SMCI scale. And barriers to entry is 3 out of 5 in stabilizing, as companies will need 12 to 18 months to enter the market and huge investments are necessary.
Mm-hmm. We're going to be going over the moat source. So intangible assets, SMCI has great patents and it has great relationships with NVIDIA. So we think that this is a very strong case. Switching costs is moderate. DLC infrastructure is sticky with high barriers to entry. Cost advantages, again, are weak. Efficiency scale is moderate. It can host 5,000 servers monthly right now. And we're going to be going over risks and mitigants. So gross margins, like Jacob said, is a very high risk. We need to see a reversal. Governance overhang is clearing up, although it's a huge risk right now. Extreme customer concentration, one customer being 63% of revenue is concerning. And NVIDIA supplier dependency. Right now, SMCI is working on a lot of contracts with other companies, so we think that this is a low level risk.
In terms of catalysts, there are a couple things we need to see. One of them being the conversion of 13 billion plus backlog into recognized revenue. The next being BDO's internal controls opinion on the fiscal year 26 10K cleaning up. And we also need to see a reversal in margin stabilization above 9%. Finally, we'll give our final recommendation where our blended target price lies within a range of $41 to $65, representing 34% to 113% upside.
And we want to reemphasize our investment points. So this is the purest infrastructure play, and its DLC market share will continue to increase and become more profitable. And with better governance resolution and DLC expansion, we could see SMCI's price go over $47. And again, I'm Johnson Chen.
I'm Jacob Liu.
and thank you for listening.